Hey everyone, it's time for some big financial news you need to know. The Federal Reserve just made a huge announcement. Interest rates are going down. This is a big deal, folks, and it's going to impact all of us in one way or another. Whether you're thinking about buying a house, investing your money, or just trying to make ends meet, this interest rate cut is going to have ripple effects throughout the economy. Now, you might be wondering, what exactly does this mean for me? Don't worry, we're going to break it all down for you in plain English, no jargon, I promise. We're going to dive deep into how this interest rate cut will affect your mortgage rates, your savings accounts, and even your investment portfolio. This is your chance to really understand how the economy works and how these big financial decisions can directly impact your wallet. We're going to give you the knowledge and the tools you need to navigate this new financial landscape and come out ahead. So buckle up, get ready to learn, and let's dive right in. This isn't just about numbers on a screen, folks. This is about your life, your dreams, and your financial security. When interest rates go down, it affects everything from the cost of borrowing money to the returns you earn on your savings. It's all connected, and understanding these connections is the key to making smart financial decisions. Think of it like this. Lower interest rates can make it cheaper to buy a house or a car because your monthly payments could be lower, but it also means you might earn less interest on your savings account. It's a trade-off, and we're going to help you figure out how to make it work for you. The important thing is to be informed. Don't just sit back and let these changes happen around you. Take control of your finances by understanding the implications of this interest rate cut and making adjustments to your financial plan accordingly. If you're a homeowner or thinking about buying a home, this section is especially for you. Interest rates play a huge role in the housing market. When rates go down, it can make mortgages more affordable, potentially leading to more buyers and even a boost in home values. We'll break down exactly how this rate cut could impact your monthly mortgage payments, whether you're looking to buy your first home or refinance your existing mortgage. We'll also explore the potential risks and rewards of taking advantage of these lower rates. Knowledge is power, especially in the world of finance. By understanding the ins and outs of how interest rates affect mortgages, you can make informed decisions about one of the biggest financial investments you'll ever make, your home. Lower interest rates don't just affect borrowers, they also have a big impact on savers and investors. When rates go down, the returns on traditional savings accounts and bonds tend to follow suit. This can be disheartening if you're relying on interest income. But don't despair, we'll explore other investment options that might offer better returns in a low interest rate environment. We'll also discuss the importance of diversifying your portfolio to weather any financial storm. Remember, every financial challenge presents an opportunity. By staying informed and adapting your investment strategies, you can position yourself for financial success no matter the interest rate environment. Here's the good news. With this interest rate cut, mortgages just got a little bit easier to swallow. That's because interest rates directly impact how much you'll pay each month on your mortgage. Lower interest rates translate to lower monthly payments, putting more money back in your pocket. Think about it this way. A lower interest rate means you're paying less to borrow the money for your home. It's like getting a discount on the cost of your loan. Over the life of your mortgage, even a small decrease in interest rates can add up to significant savings. Now, the exact amount you'll save depends on a few factors like the size of your mortgage and the terms of your loan. But one thing's for sure. Any reduction in your monthly mortgage payment is a win for your budget. If you're already a homeowner, you might be wondering if this interest rate cut is your cue to refinance your mortgage. And you know what? You might be right. Refinancing could be a smart move if it allows you to lock in a lower interest rate and reduce your monthly payments. Think of refinancing like this. You're essentially swapping out your old higher interest rate mortgage for a brand new one with a lower rate. This can free up some serious cash flow each month. Money you can use to pay down debt, invest, or simply enjoy life a little more. But hold your horses. Refinancing isn't always the right move. There are costs involved, and it's important to crunch the numbers and make sure it makes financial sense for your unique situation. This interest rate cut could be just the push some hesitant homebuyers needed to take the plunge. With lower mortgage rates making home ownership more attainable, we might see more buyers entering the market. And as demand potentially increases, home values could rise as well. For those who have been priced out of the market, this could be their chance to finally achieve their dream of owning a home. And for current homeowners, a potential uptick in home values is always welcome news. But remember, the housing market is complex. While lower interest rates can create a more favorable environment for buyers, other factors, such as inventory levels and economic conditions, also play a role. Now, before you rush out to buy a house or refinance your mortgage, it's important to remember that there are always two sides to every coin. While lower interest rates can seem like a financial gift, there are potential risks to consider as well. For starters, lower interest rates can sometimes signal a slowing economy. When the economy weakens, businesses may hesitate to invest and hire, potentially leading to job losses and slower economic growth. It's also important to remember that interest rates won't stay low forever. They're cyclical, meaning they go up and down over time. If you lock in a low rate now, be prepared for the possibility that rates could rise in the future. Okay, savers, I know this interest rate cut might feel like a punch to the gut. You're used to earning a little something on the money you diligently stash away in your savings account. But here's the hard truth. When interest rates go down, so do the returns on those traditional savings accounts. It's like this: banks make money by lending out the money you deposit. And when interest rates are lower, they don't need to offer you as much incentive to keep your money parked in their accounts. It's a bummer, I know, but understanding the mechanics can help soften the blow. But don't get discouraged. While lower rates might mean your money won't grow as quickly in a basic savings account, it's not the end of the world. It just means you might need to explore other options to reach your savings goals. If you're someone who relies on fixed income investments like certificates of deposit, CDs, or bonds, this interest rate cut might have you feeling a little uneasy. And I get it. These investments are typically chosen for their stability and predictable returns. But when interest rates decline, so do the yields on these types of investments. Think of it like this: you buy a bond that pays a fixed interest rate for a set period. If interest rates fall after you've purchased that bond, you're stuck with that lower rate, even though newer bonds might offer higher yields. It's the price you pay for security and predictability in the world of investing, but don't despair. While lower interest rates might mean adjusting your expectations for fixed income investments, it doesn't mean you should abandon them altogether. It just means you need to be strategic and diversify your portfolio. Now, if you're feeling adventurous and want the potential for higher returns, lower interest rates might actually present some exciting opportunities. When traditional savings vehicles like savings accounts and bonds aren't yielding much, it might be time to consider dipping your toes into other investment waters. Think about it. When interest rates are low, borrowing money becomes cheaper for businesses. This can lead to increased investment and economic growth, which can be a boon for the stock market. Of course, investing in stocks comes with its own set of risks, but it also offers the potential for higher returns over the long term. Remember, I'm not saying you should go all in on stocks. Investing is all about finding the right balance for your risk tolerance and financial goals. But exploring alternative investment options can help you stay ahead of the curve in a low interest rate environment. Section 4. Don't panic, diversify weathering the interest rate storm. Look, I get it. Navigating the world of interest rates and investments can feel overwhelming, especially when things are changing, but the most important thing is to stay calm, stay informed, and stay diversified. Diversification is your secret weapon against market volatility. It's like having a financial safety net. By spreading your money across different types of investments, you're less likely to be wiped out if one particular investment takes a hit. Remember, investing isn't about getting rich quick. It's about making smart, informed decisions that will help you achieve your long-term financial goals. So take a deep breath, review your investment portfolio, and make sure you're well diversified to weather any interest rate storm. All right, homeowners, listen up. This interest rate cut could be a golden opportunity for you. If you've been thinking about refinancing your mortgage, now might be the perfect time to strike. With lower rates available, you could potentially snag a lower monthly payment and save yourself a bundle over the life of your loan. Think of it like this. Your mortgage is probably your biggest monthly expense. Even a small reduction in your interest rate can add up to big savings over time. That's money you can put towards other financial goals like retirement, your kids' education, or that dream vacation you've been putting off. But here's the thing. Don't wait too long. Interest rates are constantly fluctuating. What's considered a low rate today might be considered high a few months from now. So if you're serious about refinancing, now's the time to shop around and see what kind of deals you can find. For those of you who have been dreaming of owning a home, this interest rate cut could be the sign you've been waiting for. With mortgage rates more affordable, home ownership might be closer than you think. Lower rates mean lower monthly payments, potentially putting those dream homes within reach. Think about it. You're not just buying a house, you're investing in your future. Owning a home can provide stability, pride of ownership, and even some tax advantages. And with interest rates as low as they are, there's never been a better time to explore your options. But remember, buying a home is a big decision. Don't let the excitement of low interest rates cloud your judgment. Make sure you're financially prepared for the responsibilities of home ownership, from mortgage payments and property taxes to maintenance costs and unexpected repairs. Lower interest rates don't just affect mortgages and home ownership. They have ripple effects throughout the economy, impacting everything from car loans and credit card debt to savings accounts and investment strategies. So how can you make smart money moves in this new financial landscape? First, take a close look at your debt. If you have high-interest credit card debt, now might be a good time to explore balance transfer options or consider consolidating your debt with a personal loan at a lower interest rate. Every percentage point you can shave off your interest rate is money back in your pocket. Second, don't neglect your savings. While it's true that interest rates on traditional savings accounts might be lower, it's still important to maintain a healthy emergency fund. Consider exploring high-yield savings accounts or money market accounts, which typically offer slightly higher interest rates than traditional savings accounts. I know it's not the most exciting topic, but trust me, tackling your debt is crucial, especially when interest rates are low. Think of it like this. Paying down high-interest debt is like giving yourself a guaranteed return on your investment. Every dollar you put towards that debt is a dollar less that's accruing interest. Start by creating a budget and identifying areas where you can cut back on spending. Then, prioritize paying down your highest interest debt first. This might mean making more than the minimum payments on your credit cards or exploring debt consolidation options. Remember, getting out of debt isn't just about improving your financial situation, it's about reducing stress and gaining peace of mind. And with interest rates on your side, now's the perfect time to take charge of your debt and start working towards a brighter financial future. Section 5. Stay informed, stay ahead your financial journey. Navigating the world of finance can feel like trying to read a foreign language sometimes. But here's the thing, you don't need to be a financial expert to make smart money moves. The most important thing is to stay informed and be proactive about managing your finances. Make it a habit to stay up to date on financial news and trends. Read articles, listen to podcasts, or watch videos from reputable sources. The more you know about how the economy works and how financial decisions can impact your life, the better equipped you'll be to make informed choices. Remember, your financial journey is just that, a journey. There will be ups and downs, twists and turns along the way, but by staying informed, staying engaged, and taking control of your finances, you can navigate those challenges with confidence and achieve your long-term financial goals. Well, folks, we've covered a lot of ground today, from the ins and outs of interest rate cuts to the potential impact on your mortgage, savings and investments. It's a lot to digest, I know, but the key takeaway here is this. Interest rates are a fundamental part of our economic system. They influence how much we pay to borrow money, how much we earn on our savings, and even the overall health of the housing market and the broader economy. Think of interest rates like a roller coaster. There will be ups, there will be downs, and sometimes you just gotta hold on tight and enjoy the ride. The important thing is to understand how these fluctuations can impact your financial life and make adjustments accordingly. Don't bury your head in the sand and hope for the best. Be proactive, be informed, and be prepared to navigate the twists and turns of the financial world. Remember, knowledge is power. The more you understand about how interest rates work and how they can affect your financial well-being, the better equipped you'll be to make smart decisions that will serve you well, both now and in the future. The good news is, you don't need to be a financial whiz to make smart money moves. You don't need a fancy degree or a Wall Street address. What you do need is a willingness to learn, a commitment to taking control of your finances, and a healthy dose of common sense. Start by asking yourself some key questions. What are my financial goals? Am I on track to achieve them? What steps can I take today to improve my financial situation? Don't be afraid to seek out guidance from trusted financial professionals if needed. A financial advisor can help you create a personalized financial plan, answer your questions, and provide ongoing support as you navigate the complexities of the financial world. Remember, your financial well-being is your responsibility. Don't leave it to chance or rely on others to manage your money for you. Take charge of your finances, educate yourself, and make informed decisions that will empower you to achieve your financial dreams. One of the biggest mistakes people make with their finances is waiting for the perfect time to take action. They wait for interest rates to hit a certain level, for the stock market to stabilize, or for their financial situation to magically improve on its own. But here's the thing. There's no such thing as the perfect time. The best time to take control of your finances is always right now. Don't wait for opportunity to come knocking at your door. Go out there and create your own opportunities. If you're thinking about buying a home, start researching neighborhoods, getting pre-approved for a mortgage, and attending open houses. If you're overwhelmed by debt, create a budget, explore debt consolidation options, and commit to paying down your balances as quickly as possible. If you're worried about retirement, start investing early and often, even if it's just a small amount each month. Remember, the power to change your financial situation lies within you. Don't wait for permission or a sign from the universe. Take the first step today, no matter how small, and watch as your financial confidence and well-being begin to soar. As we wrap up today, I want to leave you with a sense of hope and empowerment. Yes, the world of finance can feel complex and intimidating at times, but it can also be incredibly exciting and rewarding, especially when you have the knowledge and tools you need to make informed decisions. Make it a habit to stay curious about your finances. Read books, listen to podcasts, attend workshops, and engage in conversations with trusted financial professionals. The more you learn, the more confident you'll become in your ability to manage your money effectively and achieve your financial goals. Remember, financial freedom is within your reach. It's not about how much money you make, but about how you manage the money you have. So stay informed, stay inspired, and never stop believing in your ability to create a brighter financial future for yourself and your loved ones.